Hello, everybody. Nice once again meeting you all in this event by Cafemutual, and thanks to Prem for giving me this opportunity. So last year I spoke about how you would maintain your portfolio, but I guess this topic should have come ahead. So this is first about how you create your portfolio. So when we talk of an ideal portfolio, just hold on. Is there any such thing as an ideal portfolio? Right? So what goes into building a portfolio? Typically, broadly, three things. One would be asset allocation, because you need to understand how much of equity or gold or debt that your portfolio needs to have based on your own time frame or your goal. And then very importantly, the mix of the categories. SEBI has, more than a dozen categories out there, and you would want to know what categories to choose that would fit your own time frame or your risk profile. And then, of course, ultimately how you intend to maintain your portfolio will decide what sort of portfolio you need to build. In the sense, if you're going to be a completely hands-on person and actively manage your portfolio, then your portfolio can take some kind of a structure, as opposed to somebody who just wants to invest and shut the whole thing, right? So this is what we're going to look at. End of the day, there is no one ideal portfolio. There's always an ideal portfolio that is ideal for you, right? So I'm going to give you some guidelines on how to build the ideal portfolio for your own self. The first point that I spoke about is asset allocation. Asset allocation is something very, very unique to you, and this is where really the process of understanding your risk, the process of profiling you, etc., happens. But I'm not going to get into it because we are addressing a broad range of investors here. I'm just giving you a simple, kind of a guideline. This is not an advice; it's just a kind of a guideline on simple time frame based investing. Because end of day, whether you understand your risk or not, your time frame will determine how much risk you can take, your risk capability, right? So here I am giving you some broad ranges. For example, if you have a very long time frame, you could have very high equity. Some of you even ask us, why not have 100% equity, right? The idea is to reduce any hits to your portfolio, even while you near your goal, or sometimes in the middle of your goal when an event like 2008 happens. So we prefer to give asset allocation, right? So the asset class that you add should be one which is able to kind of complement the other asset class quite well, in the sense when, for example, when equity falls, that gold typically does well, right? So this kind of mix and match. And gold, if you notice, I have not really even put it in the initial period when you have a short-term goal, because gold is equally volatile these days as much as equity. In the past decade, gold has shown that it's very, very volatile. So this is a very, very broad range. It can help you provide some guidelines subject to you tweaking it to your own requirement. Now, the next and the most important, part of our entire discussion in these 15 minutes is about the fund categories, because that will ultimately help build or shape the kind of portfolio that you need to have, right? When it comes to fund categories, the most often asked questions, do I need large caps? Large caps are not really performing too well these days. And then, how many multi-caps or flexi-caps do I need? How much proportion of mid-cap and small cap can I have? How about hybrid funds? Can I hold a balanced advantage fund? How about international funds and so on, right? So many categories and with multiple purposes for them, right? So how do you bring them all into one portfolio or a few portfolios that you intend to build, right? To do that, first I need to understand the role of each of these categories in your portfolio, and I'm going to quickly take you through those. So again, choosing, the category or the style. When I say style, it could be a value, it could be a growth, it could be defensive, it could be cyclical, so all of these will depend on your own risk appetite and your time frame. Again, just as in our asset allocation, we said your time frame will determine how much of equity or debt goes into it. Similarly, for example, if you have a very, say something like a less than 5-year time frame or a 3 to 4 year time frame, even as the amount of equity that you can take in that period will be low, the proportion of mid caps or small caps that can get into your portfolio needs to come down, right? So to that extent, your risk appetite and your time frame plays a very large role in the nature of categories that you choose. So I'm just giving you a very, very quick example of the kind of risks that different categories, showcase. I've taken just one metric. You might, we can measure risks through various metrics. Simple standard deviation, the volatility, the up and down of a fund's returns from its mean, from its average, right? You will see that large caps tend to be less volatile, and your small caps are the most volatile, right? So in other words, if you need to have a limited risk or a less volatile portfolio, naturally the amount of small cap or mid cap you can have in your portfolio needs to come down. This is why, to curtail the volatility, we often fix a proportion to the mid cap and small cap that you can hold. So this is just to give you an understanding of the risks. So it's not like, you can go all out on mid cap, small caps, or simply load your portfolio only with large caps. You need to find the right mix for you so that your return is optimal. Now, role. So the role of different categories, like I said, large cap and even flexi cap to a large extent, because they are large cap oriented, is to provide some stability to your portfolio. In the sense, reduce this kind of volatility and ensure even in a downturn, your returns are not too hit, right? The other large and mid cap category and multi cap provides some aggression. Why? Because they do come loaded with a slightly higher amount of mid caps in their allocation as required by SEBI. Naturally, mid and small cap is to kind of just push the overall portfolio returns, but too much of such a product can not be good for you, because their hits, like I showed in the volatility, can be very high. So it's always good to curtail. I'm going to show you later a few model portfolios or on how much mid and small cap or how much of large cap I have. But this is their purpose. So the additional bit of returns more than the market returns can be expected in the mid and small cap. When I say market returns, just take the Nifty as a benchmark. International funds naturally provide diversification, because when one market is not doing well, you expect the other market to do well. Typically, in our own suggestions, we simply go with the US market, because not only is it the more, most widely traded and large market, but it has shown periods when Indian market was not doing well, it has managed to do well. So it kind of complements our market quite well. So, we say the correlation, that relatively, there is still correlation, but it's relatively lower than, say, two emerging markets. And then there are other categories of funds where I've simply put them as others. What are they? They are focused, value, contra, dividend yield. Now, end of the day, these are not market cap based like the way I've listed here. These are more strategy based. And these strategies also fall under one of these categories that I've mentioned here, right? So instead of, trying to mix, some market cap based and style based or strategy based, view them. So if a value fund is largely large cap oriented, I would tend to compare it with a large cap fund. Similarly, if a focused fund has similar market cap orientation like a flexi cap, I would tend to compare it with a flexi cap. So don't try to reduce the number of categories in your own head or in your own compilation to a limited set and try to accommodate the others in these. It's not too difficult, because when you go online, you will see the average market cap of each of these funds. So you'll know where to compare them with. So broadly, these in equity. In hybrid, you have these set of categories: arbitrage, equity, savings. Now, hybrid, in my view, play a limited role in your portfolio and for very specific purposes. So if you're just building a very long-term portfolio, in our own opinion, you don't really need hybrid if your investment amount is reasonably high, because you're going to mix equity, you're going to mix debt, and then you're going to mix gold. It's you don't necessarily need a pre-mix. Supposing you have only 1,000 rupees, you may want to use one hybrid fund to, get your equity and debt. But if you are investing 5,000, 10,000 or 15,000, their role is very limited. How limited is it? For example, in arbitrage, if you want to really park short-term money and you want equity like tax, then arbitrage suits. If you have a 2-year holding and you still want some equity, then your equity savings or balanced advantage might suit. The other, like your multi-asset, hybrid, conservative, etc., you can give them a skip in my view, unless, like I said, your investment amount is very small and therefore you need asset allocation to be achieved within that limited amount, right? Debt. So in debt, the very important thing is to understand the time frame for which you can use each category and the nature of risk in each category. Like I listed here, there are funds which you need to have a minimum time frame of 3 years and over, like your corporate bond or your medium duration, or 2 years and over, like your banking and PSU debt fund or your short duration funds, etc. You need to hold them for that minimum time frame in order to, one, benefit from the strategy that the fund is adopting for that time frame, and two, to reduce the risk that may come if you try to hold it shorter. What sort of risk? For example, a corporate bond fund, I have listed here, that needs a minimum 3-year time frame. If you come in thinking in 6 months to 1 year, you can make money in corporate bond, and you come at a time when interest rates start moving up, you might actually get hurt, because these funds typically carry 3-year, 4-year duration. When interest rate moves up, you might see your returns fall, right? So they need to go through their cycle before they deliver. This is the reason why we say certain categories of funds need to be held for at least a certain time frame. It's only at least. You can hold it as long as you want. For example, if you think you want to hold liquid fund forever, yes, please do. But the minimum time frame has to be adhered to. So this is where this slide is particularly very important, because most people are hurt in debt because they do not have this time frame in mind. They simply look at returns. They look at high gilt returns and they think they can invest in gilt for a year. Why have I put 5 years and over here? I mean, it's even 3 years is okay, because you need to have rate cycles that favor this fund, the gilt fund, because they typically hold 10-year papers or 6-7-year papers, etc. You cannot afford to have a wrong time frame and enter at the wrong interest rate cycle. So that's the biggest risk here. The other nature of risk I mentioned here is credit risk. Please also take a quick glance at those. Some of these categories where it's not obvious may still have credit risk. So you need to keep that in mind. Now, I'll move back to, we largely discussed the role of equity, hybrid, and debt. Now I'm just looking at some of my own, the allocations I would do within equity funds. There's not an entire portfolio, just within equity. You will see that I've used, when I want to curtail my risk, I'm trying to use more large cap. I've completely avoided mid and small cap. Instead, I've tried to get that mid cap from large and mid cap category or from multi cap category. And then I'm trying to broad base my portfolio, a more market based portfolio with flexi cap, and definitely some amount of international. When I'm able to take slightly more risks, maybe it's a 7-year portfolio or 8-year portfolio where I am able to take more risks, I have introduced mid and small cap. Maximum, again, this is not like you can go up to 30. 30 is likely the maximum. Why am I saying mid and small 30? Anything more than that, when we try and test, a hit in the market can deeply hurt your portfolio if your allocation to mid and small cap is higher. So that's the reason why we are trying to curtail it. And a high risk, I've entirely avoided large caps, because I think I get large caps from the flexi cap category itself, because they are oriented towards flexi cap. So I've avoided it as a category. I have taken a more focused approach to having a lesser, categories and a more proportion to these, categories. Similarly, in debt, in equity, I have done a kind of a allocation to stating the risks, depending on my own risk. In debt here, because I discussed about time frame, I'm simply saying if you have a minimum time frame of X amount, then these are the funds that are suitable and these are those that are not suitable. So I've given a no. For example, corporate bond or medium duration funds do not fit 3 to 1 year or a 1 to 2 year, or sometimes not even a 2 to 3 years, ideally over 3 years. I'm being a more conservative here. Similarly, short duration funds, 2 year plus. Floating rate funds, 1 year. In fact, there are many floating rate funds with a very high average maturity. So you might even get hurt over a 1 year time frame. So you need to be very careful in the choice of funds depending on your time frame. Within equity, within debt, if I were to build a model portfolio, what I've tried to do is provide liquidity in each of my portfolio. I'm just assumed a 3 year and 5 year. You could have any time frame, but longer the time, shorter the time frame, you need more liquidity, which means you need more, liquid, ultra short, floating rate, and so on. Longer the duration, I'm just keeping a small amount for liquidity, which is in ultra short floating rate, and I'm trying to build more medium duration funds. In my 5-year portfolio, I have one which will provide me some liquidity, and the other more where I'm willing to take some risks. So I've taken risks either in the form of gilt, which will give me duration risk, or through credit risk. Credit risk is best avoided for those who don't understand. Duration risk is okay, but not exactly at this point in time. But in general, if you have a 5-year, 7-year time frame, it is okay. You will go through bad patches, but it is okay because they will deliver over a period without any credit risk, right? If you don't want any of those, a 3-year portfolio can well be used for 5 years and 7 years, no harm. No harm using short duration for longer periods. The reverse is what causes the problem, right? So this is a kind of a model that I've used for debt. Now the number of funds that one needs to hold, right? So I've said, you could have asset allocation with some ranges. I've said you could have certain proportion of, categories of funds in equity and debt. Now I'm just trying to talk about the number of funds. So very small, you're investing, say, 5,000 rupees, 10,000 rupees, max 15. You don't need 2 to 4, more than 2 to 4 funds, in my opinion. And these should not have exceedingly high risks, right? You can take categories like, for example, large and flexi cap in equity, or a short duration fund, ultra short in debt. Just mix them. You have a portfolio. You don't have to think too hard to build a portfolio, as long as you know you're not taking undue risks with these funds, right? As your portfolio grows, you have large sums. So what happens is that if you have several lakhs or a crore and so on, the individual allocation to each fund, if you want to keep it very focused, goes up. And that causes a small amount of risk, especially in debt, because something like, an event where a fund house goes bust or some of its funds suddenly close, then you have a situation your money is blocked, right? We did go through it in 2020. To avoid that, you're saying, so there will be duplication. Please don't think that 6 to 12 funds make it very unique. No, there will be duplication, but the duplication is okay because you are diversifying your risk of liquidity or a risk, very specific to AMCs, right? So that's okay. So if you have several lakhs or you have crores, it is okay to have, about 12 funds or so, it won't matter. But anything beyond that, the diversification starts hurting. So we have done numbers. Unfortunately, in this short period, I won't be able to, share much, where diversification beyond a point doesn't yield, and in fact, returns might go down, right? For debt, very, very important that you diversify across AMCs, even if this means duplication. In the sense, you may have 2 short duration funds, one from one AMC, the other from another AMC. It's perfectly okay. Similarly with other categories. With long-term debt, when you're holding, as long as you're holding high quality funds, you don't need to duplicate. But if you're holding low quality, like a credit risk, either you keep your proportion very low or you spread it out, right? So that's where you need to know when to have similar funds across categories. In equity, you can also have, within flexi cap, you might have a fund that follows value strategy, and another fund which follows growth strategy. That is not really duplicating, it is mixing styles. Earlier, I mentioned about mixing strategies and styles. So within category, you can diversify, provided you know that a fund, you might want to ask your advisor, or you might, if you're a do-it-yourself investor, check out, there are presentations of funds, whether it follows a certain, style, and therefore will 2 of these funds put together complement each other quite well. So the mixing of styles, end of the day, really helps curtail falls in your portfolio, or reduces the underperformance, because when one style is not performing, like value was not performing for a long time, right? The other steps in. So that's where it makes sense, for you to mix styles. This is what I was talking about. So it's not just the number of funds, the mixing, for example, in debt, there is not so much of mixing styles, except that you might have little bit of short duration, little bit of medium duration. But when it comes to equity, you can truly mix styles, right? You can, look at funds that are contrarian. Then you can look at funds that are, quite growth. And then there is funds that are value conscious, what they call as growth at reasonable price, right? So you could mix all of these to achieve diversity in your portfolio, and also the performance can be a lot more predictable, in the sense something or other is performing for you. Now, the other last point that I said initially is your plan of action portfolio will decide what sort of portfolio you need to have, right? The plan of action when it comes to active funds. So if you decide you're going to go with active funds, that is no index funds, but active funds, you need to ensure that you're reviewing them regularly. You need to, of course, ensure you rebalance. When I say rebalance, your asset allocation, check whether it's gone way off where you started and bring it back to its original allocation. And of course, end of the day, you can't keep doing this every single day, right? If you keep looking at your portfolio every single day, you might be tempted to keep churning your funds. This is if you have active management. But if you don't have the time, like I said, you're just going to put money or just do a sip and not do anything, you have plenty of index funds to choose from. The same categories that I mentioned earlier, for each of these categories, you have index funds. Like a large cap, you have the Nifty 50 or 100. You have the Nifty Next 50 when it comes to something like a multi-cap or a flexi-cap strategy. You have the Nifty 500, you have a mid-cap index, you have a small-cap index, you have international passive funds, index funds, and then you have even passive debt fund of funds these days. So you could actually mimic all of these that you're doing in active funds through passive management. In passive management, only the first step will matter, rebalance annually, right? Because it's about your asset allocation. The rest, because you decided to go with the market, it doesn't matter whether you won't, there's no way you're going to outperform the market, but you're with the market, right? So that's the beauty of being passive. If you don't have the time to maintain your portfolio, this is the way forward. So your plan of action should decide on maintenance of your portfolio, should decide whether you go for active or passive funds. Finally, this is just, I've just given you a my kind of portfolio for a 7-year plus, just to give you an idea of my own thought process. I have a 75-25 mix here. I've typically, I love index funds, and, I've chosen a large cap index fund here. And, even with the flexi cap, you could go with like the next 50 or the 500 and so on. You have a small cap fund here, international fund. And then I've used in debt, mostly short to medium duration with some liquidity using ultra short floating. So it's kind of a model portfolio for me. You could look at the various other asset allocations that I had mentioned earlier and try building your own portfolio. And let's hope that you're able to do this as an exercise, and you come out with your own outcome that's favorable in terms of its performance. That's it from my side.
Hi, Vidya. That was a brilliant presentation. I'd prepared a list of questions to ask you, but now you've answered all of them. However, I need a couple of clarifications from you. For a short-term debt fund, you recommend duplication. Why is that?
Right. So our experience in the past couple of years in debt has taught us that investors' money, unfortunately, can be stuck, for extraneous reasons like sudden liquidity issue with the, fund house, or sometimes an extreme hit in its NAV. And, its inability to therefore quickly sell its papers because some of the papers had gone bad. So your money gets stuck, right? To avoid this, especially in debt, you don't want to have those kind of shocks. That's the primary reason where it is okay to have duplication, because you're diversifying across AMCs.
Okay. And in the last slide that you showed us, which was your kind of a model portfolio for a 7-year horizon, you've allocated around 50% to passive funds for the large cap, and I think some other category also you put.
The flexi cap category.
Passive fund. Now, would it be okay for someone who's really looking for a low maintenance portfolio to go much higher in passive funds?
Definitely. Like I said, I used active funds for mid cap, small cap, and so on. You could actually have those mixes with passive funds too. So that way it will still be low maintenance, and you will still get those kicker returns because your mid cap and small cap will still deliver over the large cap. So it doesn't have to be one single Nifty 50 or anything. It could still be various, index funds.
Okay. Thank you so much, Vidya. I really appreciate your being here with us, and I hope your family and everyone's keeping well.
Thanks, Prem. It's my pleasure to be here.
Okay. Great.